Imagine waking up tomorrow and discovering the world's most powerful promise. The US dollar is suddenly worthless. Not weak, not sliding, dead. Prices spike, banks shudder, supply chains freeze, and the invisible rules that held global finance together tear like paper. This is not a theory. This is a countdown to a day the world might never forget.
Money is more than paper. It's a contract of trust between citizens and state, between buyers and sellers, between countries. For decades, the dollar has been the epicenter of that trust, invoicing trade, pricing oil, anchoring reserves. But what if confidence, the true backing of any currency, evaporated overnight? Today, we'll walk through the shock, the collapse, and the aftermath, day by day, and ask the most important question: how would we survive, and who would replace the dollar's throne?
Collapse rarely arrives without whispers. In the hours before the fall, signals blink red across the global plumbing. Swamp spreads blow out. Treasury yields behave erratically. Major holders of U.S. debt quietly signal sales. Social media rumors become markets. Algorithms sense volatility and start to sell. The seeds of panic are planted, and by morning, they will sprout into a storm. It begins in Asia. Tokyo clocks in, and the dollar plunges 30% against the yen within hours. Automated trading systems cascade sell orders. Gold spikes. Oil futures gap up. Newsrooms scream, "Dollar plummets, global markets in turmoil." The Federal Reserve halts trading in select instruments and issues an emergency statement. We are monitoring extraordinary volatility. But statements can't stop algorithms. Confidence, the currency's invisible backbone, already cracks. People's first reaction is practical and primal. Run to cash, to gold, to anything that feels real. ATM queues form. Banks face a surge in withdrawals. The first fractures have appeared. By the second day, the paralysis is global. Commodity markets freeze as sellers demand payment in something other than dollars, gold, euros, or physical settlement. Oil spikes to staggering levels as tanker owners refuse to load without secure payment. Shipping lines halt routes. Factories stop issuing invoices. Cross-border payments stall because correspondent banks refuse to process dollar settlements amid settlement risk. Trade, the blood of globalization, clots. On Main Street, panic buying worsens. Supermarket prices update hourly, if they update at all. Fuel stations begin rationing. Cities experience localized shortages. Governments scramble to impose temporary limits on withdrawals to stop runs. But that only deepens fear.
Credit markets seize. Banks that relied on short-term dollar funding can't roll their liabilities. Commercial paper markets implode. Corporates with dollar debts face immediate insolvency because local revenues cannot be converted into depreciated dollars at any sane rate. Central banks in Europe and Asia convene emergency calls with the Fed. Swap lines are proposed, but the Fed itself is fighting to preserve domestic stability. Trust is evaporating faster than lifeboats can be lowered. On the street, more citizens convert savings into physical assets: gold, foreign real estate, even hard goods. Cryptocurrencies see a manic influx from those who can access them, becoming a refuge for a tech-savvy minority.
Within a week, contagion is everywhere. Emerging markets tied to dollar liabilities are the first to buckle. Currency pegs break. Dollar-denominated loans become ruinous overnight. Import-dependent nations, those that rely on dollar-priced oil and commodities, face immediate scarcity and hyperinflation. The IMF, World Bank, and other multilaterals scrambled to design a stabilization facility, but their resources are tiny compared to the scale of perceived dollar losses. Politically, pressure builds. Protests erupt where food and fuel become unaffordable. Governments that were fragile before are toppled. The geopolitical map begins to shift as nations seek new trading partners and credit sources.
The United States convenes the G7 and calls for coordinated intervention. Three options dominate: massive intervention to prop the dollar, temporary capital controls, or formally restructuring global settlement systems. Intervention requires credibility, the Fed signaling unlimited liquidity, the Treasury guaranteeing deposits, and a clear plan to restore fiscal trust. If markets suspect politicization or fiscal irresponsibility, interventions fail. Some countries pursue unilateral measures. A few major emerging economies, led by energy exporters and large reserve holders, quietly accelerate de-dollarization. Bilateral swap lines, trade in local currencies, and barter arrangements for critical commodities.
By the end of the first month, two parallel realities emerge. Inside the U.S., emergency measures, deposit guarantees, temporary capital controls, a managed revaluation begin to restore partial domestic calm. Outside, the global flow of trade is rerouting. An alliance of large exporters and regional powers announces a new settlement mechanism, a basket currency anchored in energy and commodities with initial settlements in gold-backed transfers and regional currencies. Markets call it the Eastern Basket. The dollar persists as a domestic medium but loses its exclusive reserve and settlement role. The era of a single global currency fractures into a multipolar currency landscape.
The short-term turmoil yields a slow, painful reset. Supply chains adapt to new payment rails. New clearinghouses and regional payment systems spring up. Contracts are redenominated. Economies that move fastest to arrange alternative corridors, those with resource leverage or strong regional ties, stabilize more quickly. Others are mired in debt peonage, renegotiations, and defaults. The U.S. is forced into severe austerity and heavy fiscal restructuring. A new currency architecture, possibly a partially gold-backed digital dollar, is floated to rebuild trust. But structural scars remain. Foreign reserves are diversified. Treasury market dominance has diminished. Geopolitical influence is recalibrated.
Half a year later, the world looks different but functional. Trade flows have resumed on new rails. The dollar still exists, but it shares the stage with regional currencies and commodity-backed units. Gold regains prominence as a reserve anchor for many states. A handful of financial centers rise in prominence. Shanghai deepens its role in Asia, Dubai becomes a hub for commodity settlements, and certain European clearinghouses handle large euro and basket settlements. The U.S. retains innovation and industrial heft, but its monetary primacy is diminished.
1 year on, historians will debate causes: reckless fiscal expansion, geopolitical shock, a loss of institutional trust. The consensus will be this: a global currency's strength
rests not only on military power or economic size, but on the fragile social phenomenon of trust. The crisis rewired finance. Diversification of reserves becomes policy orthodoxy. Countries build more resilient supply chains, and new governance mechanisms for global liquidity are created. Collective memory, markets, central banks, and policymakers now carries the scar of a near-total monetary breakdown.
Winners, nations with diversified reserves, large commodity exports, especially energy and metals, and alternative payment networks. Gold owners and holders of hard assets see wealth preservation. Certain tech-native assets and localized currencies benefit. Losers, heavily dollarized economies, over-leveraged corporates with dollar debts, and households with fixed incomes. Countries that failed to build alternative corridors face prolonged poverty and instability. The dollar's collapse in our scenario was not caused by a single villain. It was the result of erosion, over-reliance, political shocks, and the fragile nature of trust. The real lesson is this: money is a social technology. It works while people believe. When belief fractures, we discover how fast civilization's financial scaffolding can fail. That's why diversification, transparent institutions, and robust global cooperation matter, not as abstract policy notes, but as the real defense against financial catastrophe. Prepare your mind as you would prepare an emergency kit. Know the risks, watch the signals, and build resilience.
This is Finance Unfolded, where we take apart the systems that shape history. If this scenario made you think differently about money, subscribe, share, and join us next time as we unpack another hidden financial war.